Welcome to Financial Planning Explained. I'm your host, Mike Menninger, certified financial planner, owner, and founder of Menninger and Associates Financial Planning. Pleased to have with me one of my associates, also a equity partner, Nick DeVito, also a CFP. Thank you for joining me, Nick.
Thanks for having me.
So, back on previous demand, or what is it?
By popular demand.
By popular demand, yes. Thank you. Back by popular demand. We had a lot of feedback and a lot of hits on our episodes where we scour the internet for questions and answers because it provides topics to talk about. You know, sometimes we have guests, sometimes we have a particular topic, like last week we talked about inherited IRAs and Roth IRAs. Just various questions that are posed by a lot of people on the internet. We figured, all right, well, let's address it so we can talk about it. Ready?
Yep.
All right, cool. So this was under the category of life events. First question is, can I afford to buy a house? What's the answer?
It depends.
There you go. See, the answer to every financial planning question is, it depends. And can I afford to buy a house? That is a very, there's a lot of ways to approach that.
Yeah, it's a question that a lot of people ask, especially as they're gearing up maybe to start a family or just want to kind of move on to that next stage. That is one of those life events that people are usually working towards in some capacity.
Yeah. And so I remember when I bought my first house, it was a very stressful time, needless to say. To put it into perspective, we got married literally 1 week after the purchase date of the house. And my wife, who was on the mortgage application, lost her job a month before closing. No stress.
Yeah, that's not stressful at all.
Anyway, so the question is can I afford to buy a house? First of all, it's what you can afford versus what the bank says you can afford. Let's talk what the bank says you can afford, because if they don't think you can afford it, then guess what? You're not getting a mortgage.
Exactly.
So what the bank does is they have what's called DTI, that's debt to income. And they take all of the all of the income for the applicants. Now I say the applicants, husband and wife. If they're both buying the house together, then they take the income for both. But they also take a look at both credit scores. Mm-hmm. And they use the credit score of the lower of the two, be that as it may. So what they do is they take a look at all debt associated with each of the two applicants, or however many applicants are on the mortgage. And they take a look at your income, and let's just say they look at all your income, gross income. They use your tax returns and pay stubs to verify it. Let's say it was $120,000 a year. I did that on purpose because that's an even $10,000 a month. Then what they do is they apply either 40 or 50%, I've seen both, okay, as to how much of your monthly income, gross income, do you have in debts?
Yeah, and what Mike's saying is they essentially take your debt payments on a monthly basis divided by your gross income. That gets your debt to income ratio. And the 40 to 50% that Mike is referencing is the bank doesn't want to see your debt to income higher than that.
Correct.
When they're trying to qualify you for a mortgage. And they are factoring what your mortgage would be into that equation. So it's not just, hey, I have $1,000 a month in debt payments and I make $10,000 a month. Okay, my debt to income ratio is 10%. That's low and the bank likes to see that. But if you throw a mortgage on top of it and it now puts you at 75% debt to income ratio, well, you're probably not going to be able to qualify for that mortgage.
That is correct. That is correct. And they take into consideration homeowners insurance, your taxes, and your principal interest on the loan, assuming they're all lopped together. And then if you have a rental property, then they're going to take that into consideration, although they'll take income into consideration. They'll take a look at car loans and car leases, and they'll take a look at student loans, et cetera, and they lop it all together. And if you're above that threshold, they're going to say, no, we're not going to offer you a mortgage. Now, what I've found happen, and now the other thing that happens is that if you have a debt that's going to fall off in the next 12 months, they'll throw that out of the debt to income ratio. So for instance, if I am 8 months away from paying off my car, which is $400 a month, they'll take that off the DTI calculation, which can be good. If you're further along than that, what I've seen happen is pay off the car, because then that helps reduce your debt to income. Even though you were planning on using some of that money as a down payment, you may find that you need to pay it off in order to qualify.
Yeah, and the debt to income might not necessarily mean that you don't qualify for a mortgage at all. You might not qualify for the dollar amount that you're looking for. It doesn't mean they might not offer you a lower mortgage that that you'd be able to apply for. It's just if you come in, because typically when you're going to the bank, you're to get the pre-approval for the mortgage, you have a dollar amount that you have in mind. You have a price range that you're shopping in, and that's where they can kind of help guide you, or at least give you the answer. Okay, no, we will give you a mortgage for that dollar amount, or we won't give you a mortgage for that dollar amount. But to Mike's point earlier, there's really two components of the affordability. Sure, the bank needs to qualify you for that mortgage so you can actually get that loan, but you also need to make sure that you can personally afford it, because just because the bank says you can afford it, that doesn't necessarily mean you can actually afford it. It is not the golden ticket. Oh, bank says I can do it, that means I can do it. There's another step that you need to look a little bit more internally on to determine whether or not it can make sense for you. And then going back to the debt to income ratio, a strategy that some people have to go through, and I mean, you kind of touched on it earlier with your specific situation, is not all the time is it beneficial to have both parties on the mortgage. Because if one person has low income and high debt and the other person has high income and low debt, well, you're aggregating the two of them together. So it might actually make sense to not have both names on the mortgage. Now, then you're running into a little bit of a question there of, are both names going on the house? And that's a separate discussion for another day, not to do with the housing affordability.
Yeah, right. Well, it's funny you say that, because it just so happens that my wife was named as a mortgagee on her mother's mortgage. So now all of a sudden she had no income and a debt showing up.
Mm-hmm.
And I wasn't able to qualify for that particular mortgage. Actually, I don't remember exactly how it worked, because then it's going back a ways. But the other thing is that I know when I went through the process, I bought a $150,000 home. Good luck finding a shack for $150,000. But I think I qualified for almost $250,000 at the time. And so they said I qualified for $250,000. But, when I took a look at what the mortgage payment would be, I'm like, there's no way in the world I can afford this. Mm-hmm. And, the last thing you ever want to do is make yourself house poor. Because one of the things that happens is once you are in the house, you get expenses come up, right, Nick?
Yes, and I'm experiencing that firsthand right now. And that's one thing, the conversation I have with clients is, just because you can afford the mortgage payment, there is much more that goes into owning a home than just that mortgage payment. And I think people get so focused on that because kind of the natural thing, a lot of people are coming from a situation where they're renting and they're looking to buy, and they'll just take a look at it and they'll say, oh, well, my rent's $2,500 a month and my mortgage payment would be $2,800 a month. Oh, that's only $300 a month more. I can afford that. But what they're not thinking about is, what if something breaks? Because when you're renting, you get to pick up your phone and call the landlord, call the leasing company and say, hey, my washer broke, come fix it. The funny thing that happens, I don't know if you ever tried this, when you own a home, if you pick up the phone to try to call someone, your phone also rings right back at you. It says, wait a minute, that's you. You're the one that has to pay for this and fix it. So rule of thumb, and I kind of just like to throw this out there, is expect to spend about 1% of the value of your home every year in maintenance.
I've heard 2.
1 to 2. Yeah. I mean, if you want to be a little more conservative, anywhere in that range, just at least know that going in. If you're buying a $600,000 home and you're talking about 2%, well, that's $12,000 a year, $1,000 a month that you might want to have. So going into whether or not you can afford it, you need to make sure you consider that. And part of being able to afford it is, after you pay the down payment and actually get into the home, do you have an emergency reserve after that? Because I know some people will use every last dollar they have to get into that home, and then something breaks a month or so in. I went through that firsthand myself. Luckily, I had the emergency savings ready to go, but you just want to make sure that you're protected there, because to Mike's point, you never want to be house rich, cash poor.
The other thing, too, that happens, too, is that when you're leaving an apartment and you're moving into a single-family home, is that your utilities are almost certainly going to go up. Because when you're in an apartment, especially when it pertains to heat, where you're not only heating a smaller space, but you're surrounded by other apartments, that are heating your space as well. So you don't really have to heat that much. You move into your own home, you got maintenance like mowing the lawn. You've got, the water bill is always going to be a little bit higher. Your electric bill is going to be a little bit higher. And to your point, all of the additional expenses. Now, the reality of it is they say 1% to 2% of the value of your home is what you're going to spend every year using the $600,000 home. Even if we went with 1%, that's $500 a month. You're not going to have $500 every month. But trust me when I tell you, you're going to get a $10,000 every other year.
Yeah.
Okay, it happens. It happens. And so what the bank says you can afford and what you can afford are two entirely different things. And these are things that you really need to take into consideration, because be very careful about buying a house. You got to make sure that you can truly afford it, because if your house poor, guess what? You're literally going home every day and you can't do anything. And then you run the risk of actually racking up other debt.
Yeah, if you're going into debt outside of your mortgage to just maintain your house, I mean, your people get themselves in sticky situations that way. And kind of going back to what I was saying about, want to touch a little bit more on what really goes into the closing costs associated with house. I'll briefly touch on that, because what people think is the down payment, and that's what they have. Okay, well, I'm buying a $600,000 home. I want to get, let's say, 20% down. I need to put $120,000 down. Okay, great. I need to save $120,000 to get into the house. What they're not necessarily thinking about is all of the other closing costs that go into purchasing a home, and they can add up. And
15 grand easy.
Yeah, I mean, potentially 3 to 4% of the value of your home is what you could expect to have in closing costs just to get in the house. All the administrative fees, you're going to have to pay potentially some property or school taxes back to the seller. You're going to have to put some of your own taxes and insurance money into your escrow account. So there's a lot more that goes into it than just the down payment. And I also encourage people to think about that when they're deciding whether or not they can purchase a home, because it could add tens of thousands of dollars to your closing costs.
That is correct. And even if you went with the lowest possible down payment, being a 3.5%, you're still going to have a lot, all those expenses that you referenced, the closing costs. Plus, you got to figure you got to move. Okay, there's costs associated with moving. And particularly if you're moving from, let's say, an apartment to a house, the odds are your apartment has less furniture than the house is going to need. So there's a lot of costs. And then you need the lawnmower and you need all these things. You just need to be prepared. And unfortunately, I think a lot of people aren't necessarily prepared.
And I think, especially for those that are reaching, I know it's becoming increasingly hard just given how home prices have really gone up over the last few years. But especially if you're dealing with a married couple, buying a house that you could afford on one income will always set you up in a much better position, as opposed to maybe combining your incomes. You're still reaching for it. Might not be a good idea to be getting into that house if you're barely scraping by on both incomes. Because what happens if one of you loses your job and you're not able to get that same paying job that you have, then you really find yourself in a tough situation. And to Mike's point earlier about being house rich is, you buy a house and you always have the ability to sell it, but to break even on your transaction from buying to sell, 5 to 7 years that you need to be in that house when you're factoring in the closing costs. So it's not as simple as, okay, well, I paid X amount of dollars to get in the house. If I can't afford it, I'll just sell it in a couple of years. You might be losing on that.
Absolutely. You have to sell your house for 10% more than you bought it for just to break even on the closing cost to buy and sell. It's actually a little bit more than that. So there's a lot. So the next question is how much house can I afford? Well, it goes all in the same. You should go into it knowing what you can afford and then back into how much house you can afford.
I mean, as a good rule of thumb, I've heard 30% thrown out there in terms of 30% of your income going towards your housing payments, just to kind of give you a rough, estimate out there of maybe what you can afford from an affordability standpoint. If you're driving 50, 60, 70% of your income, your take-home pay, into paying your mortgage and taxes and insurance, probably not a good idea to do that.
Right. And by the way, when he references, say, 60%, he's talking about 60% of take-home income, which is not the same as the 40 or 50% that the mortgage uses, because they use gross income.
Yeah. And that's really where you can run into the trap there. Yeah, sure. They're looking at your gross income, but they don't know what you spend on a monthly basis.
Right.
Outside of your revolving debt payments or lease payments, they don't know what you're spending on a monthly basis. They don't know how much you're paying for insurance and just everything else you have to fund in your life. So that's where the onus comes back onto you in terms of figuring out what you can realistically afford.
Exactly. All right, so let's go to the next question. Ooh, okay. Should I pay for my child's college or for my retirement first? Hoo-hoo. That's a burning question. I'll tell you what, we're going to come back to that one as soon as we take a short break, because I just looked and I see there's a couple college questions that kind of go hand in hand. So we'll be back with you in just a few moments.
Do you keep up regularly with your investments? Where exactly are your hard-earned dollars going? Are you financially prepared for an emergency?
I'm Mike Menninger, founder of Menninger & Associates Financial Planning. We believe that education and knowledge are powerful, and we want our clients to understand why we are making the recommendations that we make. It's your money, and you deserve to know where it's going, because it's not how much you make, it's how much you keep. So call us today to discuss your financial concerns. Welcome back to Financial Planning Explained. We left off where we're starting with the college question. So, should I pay for my child's college or my retirement first?
Yeah, I heard someone say this to me a few months ago. Actually, the comment was made that retirement is the one thing that you can't borrow for. It's really tough to get a loan to retire. You can get loans for schools, you can get loans to buy a house, you can get loans for a lot of things. Can't necessarily get a loan to fund your IRA, or directly, I should say.
Yeah. Or, the other thing too is that, if I pay for my kids' education, are they going to pay for my retirement?
Probably not.
So, when given the choice, I tend to say save for retirement because it's flexible.
Mm-hmm.
If I save for my child's college, I can't, without huge penalty, I can't use those funds to pay for my retirement. But if I save for retirement, I can use those funds for college. For example, I can use an IRA to pay for college and avoid the 10% penalty. Sure, I'll have to pay taxes on it, but I avoid the 10% penalties. I'm saving for a Roth IRA. My Roth IRA principal can come out at any time. I could use that for college. The interest would be taxable if I'm under age 59 and a half, or it hasn't been in there for 5 years. That avoids the 10% penalty. But to my point, I can save for retirement and use those assets for college, but I can't save for college and use those assets for retirement.
Yeah, exactly. And I think maybe a hybrid approach can be taken there too, where you can always save for both. It's not necessarily always an either or, but to Mike's point, I would also recommend prioritizing retirement. And there's also other ways, and we're going to touch on this a little bit more, but you could also be saving for college and retirement through non-retirement vehicles. For example, using a non-qualified brokerage type of account, you could be kind of doing both, where you're stocking money away, and this money could be used for either college or retirement. And with that non-qualified account, you're not going to be subject to the early withdrawal penalties. Now, albeit if you're using, to Mike's point, if you're using the IRA Roth for college expenses, you can get around that. But that is an area where you can maybe build yourself a little even more flexibility in there, where you can kind of save for both at the same time.
Yep. Absolutely, and which provides the flexibility. Now, I just looked at the next two questions that kind of can be answered together. One of which says, how do I save for college? And the other one is, what's the difference between opening a custodial account and a 529 fund for our child's college? So what I think we can do is answer the second question, which will answer the first one. And let's talk about it from the perspective of, what are the ways with which you can save for college? And there's basically three ways. I save it in my own investment account. I save it in my child's investment account, which is what they refer to as a custodial account, or I save it into a 529 plan. So let's talk about the differences.
Yeah, I would say I'll start with the 529 plan, because that's the one that I would say people are probably most familiar with when it comes to college saving. So the 529 plan is a tax advantage account designed specifically for saving for college. The way that it works is, and I'll talk from the federal level first, if I contribute funds into a 529 plan, and let's say I contribute $10,000, come college time, it's now worth $40,000, and they're ready to be used for college. As long as I distribute those funds for educational expenses, it goes beyond just tuition. You can use it for a level of room and board, books, computers, that kind of stuff. As long as it's used for a qualified educational expense, any of that growth at the time of distribution is not going to be taxable. So it's tax-free growth as long as it is used for the purpose of education. Now, that's a federal tax level. Some states offer specific tax benefits in that state. Like, for example, Pennsylvania will give you a tax deduction for any of the contributions that you make to a 529 plan. Other states give either no tax benefits, little tax benefits. It really depends on the state. So I would encourage you to look into your specific state's rules when you're deciding whether or not to use a 529 plan, because sometimes you have to use the state-specific plan to receive any tax benefits.
Right, right. And so the other advantage of a 529 plan compared to a custodial account, which we'll talk about in a moment, is if I contributed to a 529 plan for a child, if that child doesn't go to school or doesn't use it all, guess what? I could transfer it to another child as a beneficiary. Or I always maintain ownership of it. If I maintain ownership of it, if I want the money, I need the money, I could take it. Now, mind you, I'm going to have to pay tax and penalty on the growth, but it's not a gifted asset like a custodial account would be. A custodial account, people have heard of UTMA or UGMA, UTMA or UGMA, as basically an account that I establish. It's in my child's name, but I'm the custodian, which means basically I'm the gatekeeper until their age of majority, which in most states is 18, some is 21. And what happens is that I'm the gatekeeper. The child cannot take the money out, but in some cases, the good news is that the child's taxed on it. Well, if the child doesn't have income, guess what? That's a good news. But here's the problem, is that colleges view children's assets different than they view parents' assets. Children's assets, they look at less favorably for using for college. In other words, if I'm applying for financial aid, they look at the child's assets and they say 20% of those assets are considered eligible for college. So they got $100,000 in their own account. They're going to say, well, it's $20,000 that you should be spending to college. If it was in my name, it's 5.6.
Yeah,
so,
and even better, if it's in a grandparent's name, it is 0.
Right.
So, and the only other downside that with the UTMAs is the loss of control at some point. To Mike's point, once they've reached the age of majority, either 18 or 21 years old, you no longer have control over it. It is their money to do with as they please. They get to 18 years old and you had set that money aside for college. Too bad. They want to go buy a sports car with it. They can take the money out and buy the sports car with it. You no longer have the control. And it's considered, to Mike's point earlier, a completed gift. So if you put money in that UTMA, it can only come back out for the benefit of the child. You can't just take it out to fund your own needs. I personally am not the biggest fan of UTMAs for that reason, because of the loss of control. Really, the main benefit of the UTMA is the tax treatment to the kid, I would say, is that's really the main benefit. But outside of that, I don't see a tremendous amount of benefit, which segues into the third option that Mike was...
I'll give you one benefit of it, is that compared to the 529 plan, if the child is saving money in their account, maybe not my gifting, but if the child is saving money for the account and they wanted to use it for something non-related, for instance, buying a car in high school so that they can drive to school and drive to work, then they can use their UTMA or custodial account money for that.
Yeah.
That is really the main use, in my opinion, for that.
Yeah.
Or in some cases, grandparents will contribute and say, I don't want it restricted to college. I want it to be the start of their life after college.
Yeah. And that's exactly right. I just personally think the third option that we're going to talk about accomplishes very similar goals in a much more efficient manner. And the third option that we were talking about earlier is just a regular investment account. What you always have the ability to do, and I kind of touched on it earlier, but you always have the ability to establish a regular investment account in my name only that I can kind of mentally earmark for college. Let's talk about what the pros and cons that are. Pro, I always maintain control of those investments, and I am not handcuffed as to what I can use them for. I could use them for my own personal expenses. I can use them for college. I could use it to buy a car. To Mike's point earlier, the benefit of an UTMA is it can be used for something other than college. I can do accomplish that same goal with the investment account. And two, I never lose control. So once they turn 18 or 21 years old, if I don't think they're ready to have those funds, I just don't give them to them.
Right.
So that personally, what I did for my son is I kind of have a little bit of a hybrid approach where I have a 529 plan and I have an investment account that I have kind of mentally earmarked for him, but I'm maintaining control of it. Another benefit is for the purpose of financial aid, like Mike touched on earlier, it is my asset, not my son. So when he's going to apply for financial aid, it's not counting against him as much as it would if it was in the UTMA. Downside is that all along the way, if there's capital gains, interest, or dividends, any income that is generated from that investment account are going on my tax return as opposed to your child's tax return, which would likely be at a lower rate.
Correct. All right. Okay. We beat that horse. We got a couple more minutes, so we'll sneak another one in here. What should I do after receiving an inheritance? Oof, that's a really loaded question. I don't know if we can do this in 5 minutes. So, first of all, it depends on what the inheritance is. It could be a regular investment account. It could be a property. It could be a IRA, or it could be a Roth IRA. We just spent an entire episode the last time talking about the inherited IRA and the inherited Roth IRA. In short, they must be liquidated within 10 years. Okay. But I actually had someone say, oh my goodness, let me take my $20,000 inheritance and I want to invest it. Well, in that particular instance, I looked at it and looked at their balance sheet and I said, well, you happen to have a $20,000 car loan. I said, well, here's what we do here. We take your $20,000, pay off your car loan, which is costing you $500 a month. And now for $500 a month, you could be contributing to your 401k, which you haven't been contributing to, and then have your company match. Or $500 a month can go into the Roth IRA. The Roth IRA is now growing tax-free. Again, the tax-free growth is used for retirement or designed for retirement, but it provides them with flexibility of having the assets. And so the way I look at it is that I'd rather be earning interest than paying interest. Just saying.
Yeah, that's just you though, right?
Yeah, that's exactly.
Now, I mean, when it comes to, if you're receiving an inheritance, I think the first thing that you do is figure out exactly what you're going to be inheriting. And then step 2 of that is understanding what the implications of that inheritance are. If you live in a state that has an inheritance tax like Pennsylvania does, you need to make sure that you're thinking of that, because you might have an inheritance tax bill coming down the pike. So you just want to make sure of that. I kind of view an inheritance as an opportunity to achieve your goals, whatever they may be. To Mike's point, it could be paying down debt or saving more for retirement, but really kind of sitting down, figuring out what's important to you, and then rediverting those funds to those goals, I think is kind of how you tackle that inheritance.
Without a doubt. And, seeing a financial advisor does help, predominantly because the advisor is able to at least look at it with an unbiased and no emotional attachment to it, to be able to offer the true recommendation that hopefully is best for the individual receiving the inheritance. So, all right, I'll tell you what, we're out of questions. At least we're out of time for questions. What we'll do is we'll pick this up and we'll finish another episode and we'll go from there. So thank you very much. I appreciate you coming in.
Yeah.
Thank you for joining us. And we look forward to seeing you in the next episode of Financial Planning Explained.